Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We start strong, like Krugman, the Nobel laureate, someone who's changed American economics. Claudia Sahm joins us. What do I go to first? I usually don't do this, but I am. The 30-year bond did not print 5%. We're almost there. The high was 4.9970. Yields are up. The 10-year real yield, which is a pro statistic, it jumps. That's the right language. 7 basis points, 2.34% for the yield up. And again, futures at negative 50 here. Completely unfair, but we turn to Claudia Sahm again and thank her so much for being with us. Claudia, I'm not going to do the minutia of market economics with you as well, but Anna Wong at Bloomberg absolutely nailed this optimism with a gentle revision. Is it appropriate, Dr. Sahm, to take a 3-month moving average to give Paul Sweeney and me the pulse of American labor?
I always think a 3-month average is a good place to start. I mean, they're good numbers, right? Regardless of market reactions, good news is good news. These are jobs being created. The unemployment rate ticked down slightly. Right, like we need a resilient labor market. We need a labor market that's working for all workers if we're going to get through this year, right? And so, to leave 2024 in a relatively good place, like that is encouraging. So I would take those numbers, and we've got a solid labor market still, and that's worth celebrating.
And Paul, Stephanie Roth nailed this at Wolf with the unemployment rate 4.2% to 4.1%.
Yep.
Somehow, I will suggest the President of the United States, Mr. Biden, will mention that somewhere
at some point
today.
Exactly. Claudia, how about the wages out there? The consensus was for a 4% annualized growth rate in average hourly earnings. Came in at 3.9%. How do you think about the wage environment out there?
So I think the wage environment is pretty benign, at least when we think about inflationary impacts. I mean, these are still good wage growth numbers for American workers, and that's important for making up for the prior price increases that we've seen. But in terms of the Fed being concerned about it, and they've told us for some time that they don't look at these numbers and they're concerned, it's a tick down, but essentially we've been in that same place. And if you look across a wide range of wage measures, which some more recent research coming out of the Fed has done, I mean, the underlying pace of wage growth really is pretty close to pre-pandemic pace. So this is not something the Fed should be getting real concerned about.
Dr. Sahm, thank you so much. This has become so wonderful to have you with us at 8:30 with your impact on academic and market economics. Claudia Sahm with us on this Jobs Day. And now from Morgan Stanley, Ellen Zenter joins us. Ellen, I want to go into the data and all that, but I want to go back to early Ellen Zentner, which only you and I were around for.
I'm coming in hot, just like payrolls. I'm coming in hot.
You made your name analyzing the American consumer. To me, that was the great era of economics in the past 18 months. Paul and I opened the show with a booming Delta Airlines. What does Morgan Stanley see is the state of the American consumer given this bang-on jobs report?
Look, not a lot has changed, right? People are still spending on services, not so much on goods. Travel, and especially the wealthy consumers. And so not a whole lot has changed. In this report, we see it too, right? Goods in the job sector are down, spending on goods not as strong as services. Goods are going to be impacted by tariffs more so than services. And so we're going to continue to see that shift between services gaining share at the expense of goods. But this is a more of same, good jobs market. And yes, there was a lot of rebound in this number from hurricanes and strike in the last month, and that was really the guess on how much of that payback we would get in this number. It's still the story that we've got some ever so gradual softening of the labor market, but man, it's gradual.
Mm-hmm. So, I mean, how do you think the Federal Reserve is going to kind of ingest this data today?
Well,
I don't know what number would have gotten them to change their thoughts about being on hold here. I think in December, I was more in the camp that the language that they used, the boilerplate language that they used, basically was a hard pause. And now with the January meeting, it's the housekeeping meeting where you have a lot of shifts and voters come in and out. You've got even more of a divergence between doves and hawks on the Fed. And you've got uncertainty around fiscal policy, and uncertainty means policy paralysis. Just on hold here, and we'll let you know when it's time to move again.
In the blur of this show, and trust me, folks, there's like 20 people helping me and Paul get through this every morning. I remember little things, whispers of things from weeks ago, and one of them is an Ellen Zenter whisper. You were heated at the polarity of consumption in America and your definition of the haves. Define the Ellen Zenter haves in America enjoying a 4.1% unemployment rate.
So the unemployment rate, we saw the underemployment rate also come down.
7.5%.
So we're getting strength all the way down to the most underserved in the labor market. But that bifurcation of the consumer, the top 2 income quintiles is more than 60% of all consumer spending. And
1/5 of America is 60% of consumption.
2/5. 1/5
Excuse
is
me, 2/5.
1/5 is 45%.
I just got a C- in Zentner economics.
Yeah, well,
okay.
I'm here to keep you honest, Tom.
There we go.
But Paul, this is incredible.
It is.
2/5, right? 40%?
Nailed it.
Am I close?
More than 60%.
Lisa, help me here.
You're just not getting this right, Tom. It's too many numbers.
Slide rule here.
It's a whole lot. Let's just say that.
A whole lot. Yeah,
it's
there's
a whole
my
lot.
economics.
So how does that inform kind of your view of kind of investment opportunities out there? Because it seems like the economy, whether you're looking at labor, whether you're looking at the consumer, whether you're looking at the Fed, things seem to be in pretty decent shape out there, right?
Yeah, things are pretty decent shape. I think that it means it's going to be higher for longer interest rates. It doesn't mean the Fed's not going to cut this year, and I certainly wouldn't put bets that they're going to hike based on this report, right? I would still put a very low probability that they hike at some point this year. But what you've got to do as a policymaker, if you're doing prudent policymaking, even when we start to get a flurry of executive orders after January 20th, you want to look through price increases from tariffs, because on the other side of that, you get a hit to aggregate demand. When that comes through, the Fed could still be cutting, but later this year.
Yeah, tag team Seth Carpenter and Ellen Zentner is the way to go at Morgan Stanley. Ellen, this headline just out, and I usually don't do this, but it gets to what your meetings are going to be like at Morgan Stanley today. Traders shift full pricing of next Fed rate cut to October.
Wow.
That's wow. Okay, for you, that's wow.
To me, that's a wow. That's a wow. Because I have been, one of the scenarios out there is that the Fed's going to cut, and maybe they cut just as much as they're saying they might cut this year, but it comes later. Later, because they really have to see what policies come out of the administration, and if they do hit demand later on. Okay,
I know you're not in speaking terms with Seth Carpenter, but the basic idea here is you have a twisted economics because you're Texas. You are hardwired.
I'm real.
The entrepreneur. No, I'm serious. You're hardwired the entrepreneurial nature of America. To you, Seth Carpenter, Richard Berner, Steve Roach, and everyone else in the game, do we underestimate the entrepreneurial spirit of, say, someone like Michael Dell?
I don't know if we underestimate the entrepreneurial spirit, but it was gangbusters during COVID, when people were able to have a rethink and take advantage of excess income, low interest rates, and we saw a proliferation of business startups. And that's always productive, frothy for the economy. It's just a positive all the way around. Now we're seeing productivity gains from the labor market having been so tight for so long that businesses sought efficiencies, and that's coming through now. That's not even AI yet. So American exceptionalism is real. It's very real.
Did you change your outlook? Will you change your outlook now that we are having a new administration come in and, a kind of more solid Republican Congress?
No.
No.
I think that pick your baseline. I mean, none of us know what's going to come out of the administration after January 20th. And so whatever baseline you have, it's going to be wrong.
Yep.
So you just have a lot of scenarios, and one of those scenarios will be sort of in the pocket of what we get.
What does it mean for the markets and for the stock market? I mean, it's away from your remit, as chief economic strategist. I love this. Global head of Thematic.
Sure.
Her job is to fix the Dallas Cowboys. What does it mean for the stock market? If you're sitting down with Lisa Shallett, what do you tell her?
Yeah, so Lisa and I are tied at the hip now, both on the Global Investment Committee at Morgan Stanley. Look, I wouldn't be investing in aggregate indexes here because policies are going to come fast and furious and they're going to affect certain pockets of the market. So you want to be in real assets, you want to be in energy, you want to be in commodities.
She's so Texas.
You want to be.
Well, she's got a game tonight.
I'll throw a yeehaw in there. Oh yes, and the horns are playing today.
So what are your plans for
Of course, I'm watching Landman.
Okay,
yes.
Well, what do you think? Sweeney's all over
into
this.
it.
I mean, is it an
Well,
accurate
I don't know a
picture?
lot about the patch. I'm probably learning just as much as everybody else. It's not a whole lot going on in West Texas.
But you're plus on oil and energy.
Oil,
from an American GDP
energy,
standpoint.
REITs, healthcare, financials, because it's going to be higher for longer interest rates. And so there are plenty of pockets of investment. Right now, we're very, very big on thematic investing, AI and defense, and specifically software. So there are pockets and there are things that we're excited about this year. And they avoid, you want to avoid things that are super impacted by the volatility around what policies could come out of the administration.
Ellen, thank you. Ellen Zenter with us with Morgan Stanley. We are so honored. On short notice, she came in today. Rebecca Patterson is with us with all of her work at Bridgewater over the years and, of course, at Bessemer Trust as well. What does boring, quiet money do given the shock of a 256,000 statistic? Woe is me, doom and gloom America. Forget about it. What does quiet money do this year?
I think quiet money is already invested in equities, and as long as the consumer is holding in and they have jobs and the confidence to spend, and today's data says they do, then I think you can stay in equities. Now, given valuations, the upside's going to be a little more limited unless we keep getting positive surprises. The challenge, I think, is where do you go in the equity market, right? Small cap initially rallied on the Trump win, thinking deregulation, lower rates, it's going to be great. And they've given back all of those gains from right after the election because of rising yields. Small cap needs strong growth and lower yields. And right now they're not getting enough of both.
Lisa, thanks for doing that report. Sweeney was occupied. I saw him on the phone with his realtor.
Yeah.
I got a 30-year bond, 4.99%. Wow, Paul, does that change the landscape?
It does, Tom. And we got big movement on the front end of the curve. The 2 years up 10 basis points, 4.36% there. So, Rebecca, how do you think the Fed is going to digest this data that we received today? Because the labor market looks pretty solid.
Yeah, I mean, I agree with Ellen, who was just on before me, that a January pause is baked, fully baked.
Okay, gotcha.
And now the market is discounting that the first, or next, I should say, cut, or the first cut this year doesn't come till October.
Yeah.
Who the heck knows, right? It's going to depend on all the policies that get rolled out. If the economy slows, if something cracks with the upper income consumer to hurt their confidence and cause them to pull back spending, this picture can change. If immigrants fall sharply, wage costs go up. That could, I mean, there's a lot of variables that could move us in either direction. So to me, an October cut doesn't seem crazy. I'm more interested right now in what's going on in the long end. Okay. The 10-year yield going up, pushing up mortgage rates, which is hurting the housing market, but also what's causing it, right? And we should talk about term premium.
Well, we're going to do that right now. We're going to talk about term premium because Dr. Patterson said, Tom, we're talking about term premium. Look, let me cut to the chase. You have been vetted as a Fed governor, a president, I don't know, somebody, carrying coffee at the Eccles building, whatever. You've been vetted, Rebecca Patterson. This live tweet says it all. The last cut was a mistake. It killed the Santa rally. Fold the last cut into your concern about rising yields.
Well, it's fascinating that as the Fed has cut 100 basis points, the 10-year yield has gone up more than 100 basis points. It's highly, highly unusual. What I'm worried about now is if the rise in yields is not a reflection of growth. I think today's move right now on the 10-year is stronger labor markets, so a higher Fed funds rate and strong growth. That's not a bad thing. But if the 10-year is going up because of uncertainty around policy, around Fed independence, around inflation, then you are going to see rising yields hurting stocks. And we've seen that pattern over history. That's what I'm worried about. Not the level of the yield, what's causing the rise in the yield.
Well, just to that point, Torsten Forrest and Slock, just in a matter of minutes, was out with a little note here. Higher for longer continues to be the key theme in markets. Higher for longer in the front end because of the strong economy. Higher for longer in the long end because of a strong economy and fiscal worries, which goes to your point. So I guess that kind of goes to the question, when are higher interest rates a real problem for stocks?
Again, psychologically, maybe if we crack 5%, that could do some damage in a short-term basis. But I think the bigger deal is going to be, again, what's causing it. I'm watching things like economic surprise index.
Okay.
If growth surprises are disappointing, that's bad for term premium, i.e. term premium goes up in a bad way. If inflation expectations, we have data Monday, we have CPI coming up. If those things are moving in the wrong direction, and also earnings. Look what these CEOs and CFOs are saying. If they're highlighting fiscal worries, if they're highlighting rates, that could get reflected pretty quickly in term premium, also pushing up yields.
That's right where I wanted to go. I'm going to pick on Brian Moynihan. I could be James Dimon or, frankly, any other C-class officer out there. They've got the bright lights of inflation. I got a 256,000 jobs report, 4.1%. I'm sorry, that's a nominal GDP locked in. Do we underestimate the revenue growth that we're going to see a la Delta Airlines, 6% up in business class because Rebecca's flying around the country on Delta?
Well, Delta's great. I mean, if you have to pick one, that's the one to go domestically. That's my
Every
go-to.
seat's taken.
Yeah, it's true.
I'm on Air France and they're like fist fights.
Exactly.
You know, they're all talking in French. I don't know what they're saying. But.
So what are we doing here? I think with the equity markets, one of the concerns is, boy, we really have to, if we're not going to get a rate cut until October, then boy, earnings really come front and center to support this market. Is that a risk issue for you?
Yeah, because again, there's a smaller and smaller chunk of the consumer that's holding everything up, right? The lower end consumer we know is hurting. So you need the upper middle class and the upper income consumer to continue spending. They can. They have the jobs, they have the income, they have wealth creation from housing and equities. Do they have the confidence and willingness to keep spending? And that can change quickly. Right now it looks good.
But with a nominal GDP, I mean, where would you model out nominal GDP? I don't want you to do it because I know you're not doing it because you're on this wonderful garden leave. But if you had an Excel spreadsheet in front of you, you've got to model 4.8%, 5%, 5% plus nominal GDP, right?
Yeah. No, it's hard to get bearish on equities in that environment. Again, the question is, given valuations, where do you go? And the other thing, beyond just the consumer and the job market, think about tech, right? We know, forget about NVIDIA. The rest of the Mag 7 this year, next year are going to be spending $250 billion
the Microsoft $80 billion number last Friday.
Exactly. And that's money that's going into the economy, also supporting this big nominal GDP number.
One of your family members calls in, Tom, lose the jobs report. Talk to her about the dollar.
The
dollar call from Rebecca Patterson.
I think we have another strong dollar year. The thing I'm focused on really is the Chinese renminbi. They intervened today to try to slow the depreciation. They need to depreciate, but if they depreciate in a Trump administration, he's going to come right back at them. And so what do? They have to stimulate the consumer. That is their only way out. And so far, President Xi is not willing to give on that.
Can you model a vector of depreciation back to where they were with weakness pre-2005, I think it was? That's a big move.
That's a big move.
I'm trying to make some news
Look,
here.
in 2018, the renminbi fell 10% against the dollar during the trade war. Most economists and strategists I'm talking to think that is very likely to happen again. So here's your headline. The Chinese renminbi, if the PBOC, if the central bank lets it, is going to fall 10% or more this year. The question is, will they allow it? Are they going to avoid capital flight worries and prevent it? Or are they going to do it because they need it for exports, they need it for manufacturing?
Did you change your outlook at all, just real quickly, with this new administration coming in?
I want to see which policies get pushed forward first and the size. That matters so much to me. So I think we're all going to know a lot more probably by early February.
Thank you so much for coming in today. Rebecca Patterson with us with great perspective. It's just like, I got goosebumps, folks. I mean, this is what it's about. Claudia Sahm, Stephanie Roth before that. Then we go to Ellen Zentner. Ms. Patterson darkens the door with really important comments there on currency. on the dollar strength. They got a 30-year bond. Excuse me, Stephanie Roth. We go out to 4 digits in surveillance. 5.0003. Sounds like a bank account number. We're at 5% in the 30-year bond as well. And then we finished wrong. I mean, I literally got ducky bumps here. I can't stand it. Kristina Campmany joins us right now because she's going to synthesize all the 60,000 feet garbage and bring it down to yield and price and the comfort of what Paul Sweeney talks about was I just want to get my money back. Joining us from Invesco, Senior Portfolio Manager, who doesn't describe her abilities, Kristina Campmany. Yields are up. Are your portfolios hurting? Because I believe price is down.
Prices are down. Look, we have been looking for a steeper curve. That's kind of been our thesis much of last year. Happening. And you take a step back. A month ago, we sat down post payrolls, and I think we talked about like what's a reasonable range for 10s when we have all of this uncertainty about policy and what comes through. And we talked about 425, 475, and I feel like throwing out 475 a month ago when we were sitting at 420, people looked at you like you were crazy.
Yes, we did.
Here we are.
And here we are at 478. And in that time, you've had this massive reprice, and now you have the market chatter talking about 5 and 525 and 550. We've done a lot of work. So I think from here, to Ellen's point, like we're all kind of in this holding pattern of what kind of policies do we get, and are there risks to further higher yields? For sure, in a steeper curve. But I think the bar for the Fed to hike is very high. I think that there's a lot of value in the front end. Even with, we sold off even more today, I don't think we should be pricing in hikes.
Because again, the red headline crossing the Bloomberg terminals that traders are now saying maybe the first rate cut won't come until October. Does that seem reasonable to you?
Look, I think part of that, when you strip it out, is people pricing in, or the market pricing in, trying to price in some probability of a hike, which we don't think is realistic. But I think it's right that the Fed is in this wait and see period, as is the market of, we know we're getting inauguration in a few weeks. What are the policies? And it's still the question that we've had since Election Day. What is the mix? What is the magnitude? What is the timing? What's the order?
Bring this back to the people listening on their commutes this morning, the people waking up on the West Coast in a shattered Los Angeles, and even to the pros. Forget about all the spread malarkey. Forget about, all the Frank Fabozzi stuff. Do I just buy a 2-year or a 6-month, 1-year CD and wait for the damage to clear?
Look, I think that you're starting to get to a point that there's some value at the curve to say, like, should I invest some money in 10s?
Where's your out the curve?
I think 10s is where you're safer. I think 30s you have more. What is our fiscal? What goes on? And we're gonna have this headline roulette, but we've had that already. Like, to get rid of the debt ceiling, like you're gonna have noise there as a result. So, real yields is another one. Like, you start to talk about long end real yields around 250, plus you're getting what inflation in fact realizes.
233.
As a personal investor, that probably makes sense. Of, can you put that in your portfolio in a mix with, you have some cash, you have some combo of risk assets.
How about credit risk here? How much credit risk are you taking in this market?
So we have been a bit more cautious on U.S. credit risk, probably to our own detriment within our own funds. And again, we run global funds. We have obviously within Invesco people that are more specifically just looking at credit. And again, I say to our own detriment because it's continued to perform exceptionally well. And you look at even the start of the year, like the corporate supply numbers this week are incredible.
Stunning. Why? Why are they getting out in front of the
I think like part of
administration?
it's probably some of that, and part of it is just always January seasonals of calendar of issuance coming out. But you look at that, and IG spreads are incredibly well behaved, and I think you have this sentiment in the market about positive U.S. and really negative the rest of the world. And so is there some risk that U.S. credit can in fact widen because the sentiment is so rock solid there that you could have a break? But
you can't talk individuals, but let's say one of the Mag 7 calls up and goes, Kristina, we need a cup of coffee. What do you tell them about the magnitude of debt issuance now? Yields are up. Instinctively, Paul, I'm like, don't issue. And yet, as Kristina mentions, it's been nuts.
Yeah.
Is that what we're going to see here?
It's been nuts, and I think the market is more sensitive and reactive to, I don't think on a corporate level there's a lot of concern of you have strong balance sheets, you have a strong consumer. And then from nations, if you look at like debt levels, U.S. debt levels are things that you think the market should be like falling out of its chair for a number of years now as we push this. But the market gives a lot of, you've had this U.S. exceptionalism story for a decade. So it gives the U.S. a lot of grace.
Paul, get one more question in here. Folks, Anna Wong will join us with a market open at 9:30. She nailed this jobs report. Dr. Wong will join us from Bloomberg Economics. One more to Kristina Campmany.
The curve is steepening. What does that tell you?
I think I'm a little surprised of just today post this number that you've actually seen a further move in the front end. And I think to what we discussed, it's the market talking about like, will you really have hikes from the front end? I think from here, the curve can still push a bit steeper because you have all this uncertainty and questions about what is fiscal, what are debt, what are policies, what does inflation look like, all of these things that when the curve is in swaps, 2s10s is pushing 10 basis points, you don't have a lot of premium there. Like cash is 40. Historically, we've seen way steeper numbers. So I think that there's clear value in the front end here because I think that the bar for the Fed to hike is very high and that you can still see that's the bias still.
I have no idea what she just said to you, Paul.
I'm all in.
She starts slipping into Invesco talk.
Yeah.
And it's just like Rob.
It's bond people. They're bond people are different. Yeah.
They're just different.
Yep.
Okay. Kristina Campmany, thank you
They
so
want to
much.
get paid back is the thing.
They do. They want their money back.
Yes.
And Kristina, use your Bloomberg terminal today, please. Kristina Campmany with us with Invesco.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Joining us now is the laureate, and there is a Ned Phelps Paul Krugman distinction. In the year where Professor Krugman took the trophy, he was the sole winner. I can't tell you within modern economics how special that is. I've been a fierce defender of his international economics, retiring from the New York Times column where he's been a lightning rod of debate, and we are honored that we can speak our international economics forward with Paul Krugman. Paul, thank you so much for joining Bloomberg this morning. If you had a cup of coffee in Mar-a-Lago with President-elect Trump this morning, how would you brief President Trump?
I would ask, what on earth do you think you're doing? It's we're looking at a U.S. economy that, this morning's jobs report was really good. Everything is kind of coming up roses. It's soft landing everywhere. And yet he's preparing, or claims he's preparing, to go on this trade war against everybody. And the question really is, why? What is it? Why do you want to do something so disruptive when you're inheriting an economy that is really looking pretty good?
I'm looking, Paul Krugman, it's something you taught with a piece of chalk at Princeton and at City College. The basic idea here is a tariff chart, which is the microeconomics and dynamics. We talked to Richard Clarida the other day about the deadweight loss of tariffs. For our listeners, the magnitude of tariffs, does it matter? Or is this just simply a deadweight loss to each American citizen?
Oh, no, the magnitude. I mean, one of the things that you learn from studying the economics of tariffs is that tariffs at low rates do very, very little harm. We had an average tariff of something like 2 to 3%. We do at the moment coming into this.
Right.
That, if you ask, how much difference would it make if we got that down to zero? The answer is basically invisible. But if you go from 5% to 25%, which is what Trump's talking about for everybody, and 60% for China, then it's, roughly speaking, we think that the losses go up roughly as the square of the tariff rate. So with Trump talking not about a modest increase in tariffs, not about tariffs on a few products, but across the board trade war, Smoot-Hawley tariff levels, that starts to become a really, really big deal.
Paul, I've been and folks, the textbook on this is Krugman Opsfeld. It's all, again, you throw Ken Rogoff in as well, but Krugman Opsfeld, there's some adult textbooks out there of what Krugman invented for us in international economics. Paul, I've always defended you by saying the Venn diagram of Krugman economics and John Taylor economics at Stanford is pretty tight. Can Kevin Hassett advise this president towards some form of tariff moderation or sanity?
Kevin Hassett has a history of basically saying whatever. I mean, he's been a loyalist and a courtier. I would be really shocked if he goes to, tariffs appears to be a real Trump obsession, and I'd be shocked if Hassett or actually anybody stood up to Trump and said, "Mr. President, you're thinking about this all wrong." I've been writing. For listeners, I'm retired from the Times, but not from life, and I'm writing almost every day on my Substack.
Your Substack? He needs to make a buck on this. That's what it is, Paul.
Well, it's free at the moment.
How do they still see your writing as you've exited the Times?
paulkrugman.substack.com.
There you go.
Or just Google Krugman Substack and you'll find it. And look, I'm free to. It's a newsletter / blog, and I'm in. And what I wrote the other day was we're seeing a continual dynamic where people who claim to be close to Trump but remain anonymous tell newspaper writers, "Hey, he's not really as crazy as he sounds," and then Trump immediately reacts with a Truth Social post saying, "Yes, I am." So it does look like we're really talking about, in tariffs on a scale that we really have not seen. We're talking about a reversal of really 90 years of U.S. policy of trying to.
Where I wanted to go, Professor. I mean, I grew up on Global Wall Street, and many of our listeners and viewers as well, of internationalism being a fundamental business tenet. Now, that's taken a back seat here over the last 10 years. Is internationalism dead?
Well, probably in the form it was, yeah. I mean, a lot of this was U.S. hegemony, and we thought that a more prosperous, peaceful world was in our interest. What was good for the world was good for America, and we thought that freer trade was good for America, and we led the way. We built a world trading system kind of in U.S. In our own image. It's very rules-bound, legalistic. And it worked. We managed to get everybody's tariffs down. We got to a world of pretty close to free trade. We've been, in the last couple of decades, the European Union, which is not very united on many things, but is unified on trade policy, sort of co-managed the system with us. Now we've gotten much more nationalistic, and even Biden was pursuing, for I think pretty good reasons, some pretty seriously nationalistic policies, specifically on technology and China. But so the age of full-on more globalism is good. That's behind us.
Yep.
That really died about a decade ago. But there's a big difference between saying, okay, we're going to be much more selective about this and maybe even be protectionist here and there, and saying, Smoot-Hawley had the right idea, which is basically what Trump is saying.
Right. So, Professor, today's a big jobs day here on a Global Wall Street, showing again the strength of the U.S. labor market. That calls into question another one of the president-elect's policies, which is about immigration and what to do with the migrants that are already here. From an economic perspective, how would you advise the president on thinking about immigration policy?
I mean, immigration has been one of the great strengths of the U.S. economy. Whatever else you may think about it, it's not actually a source of crime or any of the things that he says, but the immigration has been a tremendous safety valve. It's helped to contain inflation, and immigrants, particularly, if I might say, undocumented immigrants, they're not evenly spread across the U.S. economy. They're a really critical part of the labor force in some particular sectors. If you're worried about agriculture or meat packing or construction, those are all sectors where we have the native-born population is aging. The working age native-born population is shrinking because we've had low fertility for a really long time. So that without immigration, we would be we would be Japan. And from an economic point of view, this is a tremendous self-own.
Paul Krugman with us. We are thrilled that he's with us here with CUNY, CUNY's Stone Center on Social Economic Inequality, among others, and affiliated also with the LSE, I should say, and of course years at Princeton as well. I talked to him about his first paper once at Yale, which was on Star Trek. This is a few years ago.
Is that right? Okay.
Yeah, just after Ricardo. But the answer is the laureate Paul Krugman with us. Thank you for the huge response to Professor Krugman with us this morning. Paul, I've said this before, but I guess there can be a tour of duty when you win a second Nobel Prize. You deserve a second Nobel Prize for your persistent discussion of wages and monopsony in America. Folks, monopsony, the model, is a rubber plantation in Malaysia where the rubber plantation sets the price because they have power over all the farmers and the rubber trees and the manufacturing process. Professor Krugman, how is monopsony in America affecting our listeners and our viewers on YouTube?
Oh, gosh. I mean, in a way, what it's telling you, I mean, the main monopsony issue on wages is that it's okay to raise the minimum wage. I mean, this is where we really started to take it seriously when you first had the work by Card and Kruger, now replicated by many people, which says that local minimum wage increases don't actually reduce employment. Econ 101, unless I have to say, even in my own textbook, we do talk through how a minimum wage can reduce employment, but it doesn't actually seem to happen in the United States. Now, that's because minimum wages are low in the United States, and if you set the minimum wage at $40 an hour, even I would accept that would have some employment consequences. But so that's the main place where it hurts. Although if you are a small supplier or something trying to peddle your stuff on Amazon, the fact that you've got a giant Bezos-sized monopsonist certainly affects your business.
I mean, it's very interesting to see Paul Krugman and the conservatives listening. I'm going to frame this, Paul, as a liberality, in a way is a Lockean individualism of conservative theory in America. Should we be more like Germany, flat on their back? Should we be more like Sweden? Should we be more like France?
Well, I mean, ideally, we should be more like Denmark, which is a place that does strong welfare state, strong unions, and does it well. It's everybody's got. One of the things I've spent many years teaching a course, first at Princeton, then at CUNY, on economics of the welfare state, comparing different countries. And one of the things you learn, first of all, the United States has we have a much bigger welfare state than we like to imagine, but it's much smaller than what European countries have. But there's no country that does everything right. U.S. healthcare is a nightmare. U.S. retirement system is actually pretty good. France, it's exactly the opposite. So it's not a simple more government is good. I mean, I think conservatives always think that less government is good. Liberals, progressives never think that more government is automatically good. But there are certainly things where we should be doing more, and obviously that's on hold for the next few years. But there are lots. We can learn a lot from other countries. If that's one thing I would say as an international economist. The biggest problem with Americans is that we don't actually seem to believe the rest of the world exists, and we don't think that we can learn lessons from things that other countries do right.
Professor, most of the market participants that we speak to, particularly over the last several months, and they see a data point like today's non-farm payrolls, and they feel like the Fed has engineered a pretty solid, soft landing. What concerns you? What worries you about this U.S. economy right here?
I think the U.S. economy, as of right now, is in very good shape.
Okay.
I am worried. I've been around a while, and the whole AI furor and all of the money being thrown at that technology gives me definite 1999 vibes. The sense that we may be having, even if the technology does do a lot of good stuff, and there's some indications that it will, the valuations look awfully high, and you can very easily imagine a kind of 2000, 2001 type. But the biggest concerns are policy. I mean, if you actually believe that Trump is going to do what he promised in the campaign with these massive tariffs, mass deportations, and let's not forget, taking away a lot of the Federal Reserve's independence, it's not at all hard to see us gratuitously. I mean, we're in good shape right now, but we could very easily have a gratuitous outbreak of stagflation in America, and it will be entirely coming top down from the White House.
Very quickly here, Professor Krugman. Paul, we got to do this or Krugman won't come back. The Substack this morning, the real threat of fake numbers. Paul Krugman, are you suggesting the president and his administration will cook the books?
I think that's a very high possibility. If you believe what I'm saying about inflation is actually going to go up substantially. And do you really imagine that Trump will just sit there and not say these are fake numbers, it's fake news, and put pressure on the Bureau of Labor Statistics to produce better numbers? Yeah. I mean, we've seen populist regimes do that all over the world. Why imagine that it won't happen here? And I know that people who've had long careers at the Bureau of Labor Statistics are really worried about this. So I was just saying, flag this. This is something to watch.
Paul, generous of your time. Thank you so much again. Paul Krugman, A New Life. He got it from Adam Tooze. Yeah. Substack.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Our newspapers, the front pages, in all her glory, the Lisa Mateo Hour. What do you have?
Well, we're all about the data, right? So the data is showing that Americans tipping less than they have in years.
Oh, is this a hot topic?
Yes, this is a hot topic because two reasons. Rising menu prices, and the other one is people are just getting tired of all the prompts. You get the screen that turns, but places you didn't get it before.
No. So here's the problem.
What do you do?
Hard and fast rule. Here you go. If you stand, no tip. If you sit, tip.
Really?
That easy.
That's it. Tell me that doesn't work like 9 out of 10 times.
It's tough. It's like the pressure's on. You're standing there and they flip the screen and then you're like, what do I do?
Yep.
I just hit a wall a year ago or so, and I just don't tip. Sort of like standing. I think that's brilliant.
Yeah, I do.
Yeah.
And I tip my local place. My local places.
Yes.
I tip in a restaurant. I always tip very well, 20%. Then I round up. Okay. And in my local places where I know the servers, where I go all the time, I'll tip above and beyond that. So I want to walk in there and say, Sweeney's a good tipper.
Right. In Paris, I tip big like an ugly American. They love me. In London, it's so screwed up. The waiters they're ruined by the way they do tipping in London. It's terrible.
Because they get paid more, right?
That's the gimmick, but I don't buy it. They're getting taken to the cleaners in London. Next.
Okay, we all know the price of beef, right? On the rise. Yep. But did you know it could get even higher because of freezing temperatures in the Corn Belt? I did not realize that, but the Wall Street Journal breaks it down because colder weather in pastures produce this thing called prussic acid in the grass, and if the cattle eat it, they can die. So the cattle producers are having to regulate what these cattle are eating, and so the cattle are losing weight, and so lower weight cattle produces less beef, which means the prices are going to go up.
All right, I watch Yellowstone. I know all about the ranching business. That is a tough business, man. I don't know why that is hardy souls of people. I mean, there's so many areas where you can get screwed in the ranching cattle business. That is a tough way to make a living.
It's like a double whammy because the USDA just suspended exports of live cattle from Mexico because there was a parasite appetite found in those, and they haven't lifted it yet. So that on top of these freezing temperatures.
I'm looking at live cattle on the Bloomberg. It's a moonshot.
I know.
It's basically a double off the pandemic. Yep. Wow. Next.
Okay, so there's a new...
I learned something.
I know.
Well, you're going to learn something here. Okay, there's a new side hustle where people are earning about $30,000 making job referrals for strangers. Okay, so stick with me here, okay? Companies offer these bonuses, right? So when you refer someone, you get a nice bonus. Usually it's someone you know, but not anymore. One tech worker told Bloomberg he referred over 1,000 job candidates. He earned $30,000 in bonuses. He didn't even know them. They were all copied and pasted. And the reason why it's so big is because job seekers are going to these underground places like Blind, Glassdoor, Refer Market, and they're making the connections. And people are just saying, hey, I'll refer you.
Lisa, that's how I got my job at
No, you're not supposed to say that.
One more.
Finally, I got to go congestion pricing, okay? So with this, there's no surprise here. Congestion pricing is sparking these phishing scams. So now people are getting text messages from toll fishers saying that they owe a late fee. And then people are clicking on the link, going to these websites.
Thank you. That's important.
Yeah, so it's very important. They're putting out the warning, don't fall for it.
I got 30 seconds. None of this matters on Jobs Day. You've detected an egg shortage?
Yes. I went to the supermarket. There were no eggs anywhere. I talked to our expert, Ken Fellew, who told me that he's having the same issue. Gone. And the prices are sky high.
The bird virus?
The bird flu. Yes, the bird flu. But Ken says go to Walmart.
Lisa Mateo, thank you so much. The newspapers.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.